Chapter 4 discussions will cover ethics, independence, and other ethical requirements expected in practice. At the end of Chapter 4, you should be able to do the following. You should be able to distinguish behavior that is ethical from one that is not ethical in personal and professional contexts. At the end of Chapter 4, you should also be able to resolve ethical dilemmas using an ethical framework. You should be able to explain the importance of ethical conduct for the accounting profession. You should be able to describe the purpose and content of the American Institute of Certified Public Accountant Code of Professional Conduct. In addition, by the end of the chapter, you should be able to apply the American Institute of Certified Public Accountant Code rules and interpretations on independence and be able to explain the importance of the AICPA code rules and interpretations. You should be able to understand the Sarbanes-Oxley Act and other Security Exchange Commission and Public Company Accounting Oversight Board independence requirements, as well as additional factors that influence the auditor's independence. You should be able to understand the requirements of other rules under the AICPA code. And lastly, at the end of the chapter, you should be able to describe the enforcement mechanisms for certified public accountant conduct. So how does the certified public accountant distinguish between ethical versus unethical behavior in personal and professional contexts? Ethics can be defined broadly as a set of moral principles or values. Examples of prescribed sets of moral principles or values include laws and regulations, as well as the codes of business ethics, together with the codes of conduct within organizations. Ethical behavior is necessary for a society to function in an orderly manner. The need for ethics in society is sufficiently important that many commonly held values are incorporated into laws. In here, we have an illustration of the 6 core ethical values that the Josephson Institute associates with ethical behavior. The first value is the value of trustworthiness. This value under this illustration includes honesty, integrity, reliability, and loyalty. The second core value in this illustration is respect. A respectful person is one that is defined or seen as being civil, courteous, decent, dignified, tolerant, and accepting of individual differences and beliefs without prejudice. The third core value under this illustration is responsibility. Responsibility means being accountable for one's own actions and exercising self-restraint. The next core value is fairness and justice. This value includes issues of equality, impartiality, proportionality, openness, and due process. The fifth core ethical value is caring. Caring means being genuinely concerned for the welfare of others and showing benevolence. And the last 6 core value under this illustration is citizenship. Citizenship means obeying the laws and performing one's fair share to make society work. If you would want to look at this illustration after the video course presentation, you can find figure 41-1 on page 79 of your textbook. If there are core ethical values that exist, then why do some people still act unethically? There are 2 primary reasons why people act unethically. The first reason is the person's ethical standards differ from that of the general society's standards. And the second primary reason that people act unethically despite the existence of core ethical values is the person chooses to act selfishly. Most people define unethical behavior as conduct that differs from what they believe is inappropriate given a certain circumstance. In addition, a considerable portion of unethical behavior results from a person's selfish behavior. In the next few slides, we will discuss about ethical dilemmas and the methods that a certified public accountant or practitioner can use to resolve it. By definition, an ethical dilemma is a situation in which a person must make a decision about appropriate behavior. In practice, auditors, accountants, and other business people face many ethical dilemmas in their business careers. Unethical behavior can result due to rationalization methods employed when a person is faced with an ethical dilemma. The rationalization that everybody does it and therefore it is acceptable is one common method employed to rationalize unethical behavior. Another rationalization method that is employed is the use of the argument that if it is legal, then it must be ethical. For example, a person would argue that she or he has no obligation to return a lost object unless the other person could prove that the object belonged to him or her. And lastly, the philosophy of evaluating the likelihood of discovery and consequences is another common method of unethical behavior rationalization. For example, a seller is deciding whether to correct an unintentional overbilling of a customer when the customer has already paid the bill in full amount. The seller will decide to inform the customer about the error if the seller evaluates the likelihood that the customer will detect the error and respond by not buying in the future. Otherwise, if the seller evaluates the likelihood that the customer will not detect the error, the seller will wait to see if the customer complains. Formal frameworks have been developed to assist people in resolving ethical dilemmas. The following 6-step approach is one method for resolving ethical dilemmas. The first approach would be to obtain relevant facts related to the ethical dilemma, followed by the identification of the ethical issues from the facts obtained. The third approach would be to determine who is affected by the outcome of the dilemma and how each person or group will be affected, followed by the identification of the alternatives available to the person who must resolve the ethical dilemma. The fifth approach to resolving ethical dilemma is the identification of the likely consequence of each alternative. And lastly, the sixth approach would be to decide the appropriate action in order to resolve the person's ethical dilemma. So far, we have covered during the discussion moral principles and ethical values, as well as the six core ethical values, together with the ethical dilemmas that a person faces and the method and approach that a certified public accountant can employ to resolve ethical dilemmas. Moving on, we are now going to be discussing the importance of ethical conduct for the accounting profession. Our society has attached a special meaning to the term professional. The term professional means a responsibility for conduct that extends beyond satisfying individual responsibilities and beyond the requirements of our society's laws and regulations. A certified public accountant, as a professional, recognizes a responsibility to the public, to the client, and to fellow practitioners, including honorable behavior, even if that means personal sacrifice. Certified public accounting firms have a different relationship with users of financial statements than most professionals have with their customers. Most clients pay professionals for services, and the professional's primary responsibility is to the client. Certified public accounting firms are engaged by management or the audit committee and paid by the company, but the CPA firm's primary responsibility is to the users of the financial statements. It is essential that users of the financial statement regard certified public accounting firms as competent and unbiased. This is contingent on the certified public accounting firms conducting themselves at a high professional level. In here, we have a summary of the most important ways in which certified public accountants can conduct themselves appropriately and perform high-quality audits as well as related services. In the United States, the two most influential factors are the AICPA Code of Professional Conduct and the Public Company Accounting Oversight Board and Security Exchange Commission. The Code of Professional Conduct is meant to provide a standard of conduct for all members of the Institute of Certified Public Accountants. The Public Company Accounting Oversight Board is authorized to establish ethics and independent standards for auditors of public companies. On the other hand, the Security Exchange Commission plays a significant role in establishing independent standards for auditors of public companies. If you want to look at this summary after the video course presentation, you can find figure 4-2 on page 86 of your textbook. The American Institute of Certified Public Accountant Code of Professional Conduct has a purpose in the accounting, audit, and assurance practice. In the next slide, we will discuss the purpose and content of the Code of Professional Conduct. Members of the American Institute of Certified Public Accountant agreed to follow the Code of Professional Conduct. The code consists of principles and rules in addition to interpretations. The principles of the Code of Professional Conduct provides the framework for the rules that govern the certified public accountant's performance of professional responsibilities. Interpretations of the rules address circumstances where members may face threats to compliance with the rules of the professional conduct. In addition, the American Institute of Certified Public Accountant bylaws require that members comply with the rules of the Code of Professional Conduct. Please do keep in mind that only members in public practice can audit financial statements. In here, we have a detailed table of the organization of the Code of Professional Conduct. The organization has 4 sections. The first section is the preface of the code. In this section, it contains the principles of professional conduct which all AICPA members must follow. The second section of the Code of Professional Conduct is Part 1 of the code. This section contains the conceptual framework as well as the rules and interpretations for all members in public practice. Following Part 1 is Part 2 of the code. In this section, it contains the conceptual framework as well as the rules and interpretations for members in business. And lastly, the last section would be Part 3 of the Code of Professional Conduct. This section contains the rules and interpretation for other members of the American Institute of Certified Public Accountant. You can find Table 4-1 on page 85 of your textbook. In here, we have a detailed table related to the ethical principles. The principles indicate the profession's responsibilities to the public, to clients, and professional colleagues. The principles are designed to guide members in the performance of their professional responsibilities and in meeting the basic requirements of ethical and professional conduct. The principles for professional conduct stress a commitment to honorable behavior that overrides personal advantage on the certified public accountant's part or any practitioner within the industry. You can find Table 4-2 on page 86 of your textbook. To assist members in situations that may provide a threat with compliance with the rules of professional conduct, the code offers the following conceptual framework for members to evaluate threats to compliance with the code. The first conceptual framework would be where a member should identify situations which may lead to threats to compliance with the Code of Professional Conduct, followed by the members' evaluation of the significance of the threat to the compliance with the Code of Professional Conduct. And lastly, a member should identify and apply safeguards to eliminate the threat or reduce it to an acceptable level. Safeguards fall into three broad categories. Safeguards created by the profession, legislation, or regulation is the first category in which a member could employ. The second category would be the implementation by the client, followed by the implementation of safeguards by the certified public accounting firm. In here, we have a table that provides a definition of each threat to the Code of Professional Conduct, along with a specific example of a threat to compliance with the rules. For example, an officer, director, or significant shareholder participates in litigation against the firm. This may represent a threat that a member will not act with objectivity because the member's interests are opposed to the client's interests. If you read through each example of a threat on Table 4-3, you will gain an understanding of each threat and the impact of the threat on a member's compliance with the rules or code of professional conduct. You can find Table 4-3 on page 87 of your textbook. Interpretations of the rules of professional conduct arises when there are frequent questions from practitioners concerning a specific rule. Interpretations provide guidelines about the scope and application of the rules, and members must justify any departure from the rules in a disciplinary hearing. Most rules of the Code of Professional Conduct apply to all AICPA members. However, the independence rule only applies to members who are providing attestation services. When practitioners conduct themselves at the minimum level, this does not imply unsatisfactory conduct. What it does imply is that the profession has presumably set the standards sufficiently high to make the minimum conduct satisfactory. The difference between the standards of conduct set by the principals and those set by the rules of conduct is shown in Figure 4-3. It also illustrates the expectation for the level of conduct for all practitioners, whether the practitioner is in public practice or not. You can find Figure 4-3 on page 88 of your textbook. Moving on, how does the AICPA code rules and interpretations apply to the auditor's independence? And why is the AICPA code rule and interpretations important? The value of auditing is dependent on the public's perception of the independence of auditors. Because of the importance of auditors' independence, the first rule of the AICPA code is the independence rule. The independence rule states that a member in public practice shall be independent in performance of professional services as required by standards established by bodies designated by the Council of the AICPA. Independence consists of two components. The first component being the independence of mind of the auditor, also referred to as independence in fact. The second component is the independence in appearance. There are a lot of interpretations for the independence rule than for any of the other rules in the Code of Professional Conduct. However, the most significant interpretations involving independence include the following items: financial interests, related financial interest issues, consulting, bookkeeping, and other non-attest services, litigation between the CPA firm and client, unpaid fees, and lastly, the network of CPA firms. The Code of Professional Conduct prohibits covered members from owning any stock or other direct investment in audit clients, as it is considered significant financial interest. A covered member is defined as any person who is in a position to influence an attest engagement or audit engagement. The prohibition of direct ownership also applies to the covered member's immediate family, which includes the member's spouse, a spousal equivalent, and dependents. So what is the difference between a direct versus an indirect financial interest? By definition, ownership of stock by a covered member or a member's immediate family is considered a direct financial interest. On the other hand, a close but not direct ownership interest by a covered member or a member's immediate family is considered an indirect financial interest. Materiality impacts a member's violation of the rule only when ownership is a violation of independence for an indirect ownership. Materiality must be considered in relation to the member's wealth and income in this particular case. For example, if a covered member has a significant amount of his or her personal wealth invested in a mutual fund, and that fund has a large ownership position in a client company, a violation of the code may potentially exist. In contrast to indirect ownership, any direct ownership interest by a member of the AICPA is prohibited regardless of materiality. Ownership by a close relative is usually not a violation of independence unless the ownership is material to the relative or enables the relative to exercise significant influence over the attest client or the audit client. Close relatives are defined as a parent, a sibling, or non-dependent child of the covered member. Any of the following relationships between a certified public accountant and the client could impact a member's independence and potentially lead to a violation of the rule of professional conduct. A loan between a CPA and a client, other than normal lending procedures, could impact a member's independence and potentially lead to a violation of the rule of conduct. The employment of an immediate and close family member, as well as a joint closely held investment with clients, or a member becoming a director, officer, management, or employee of a client company, especially if the client is an attest or audit client, then the member could potentially be in violation of the rule of professional conduct, as this relationship impacts the member's independence. In the next few slides, we are going to discuss the independence requirements of the Sarbanes-Oxley Act, the Security Exchange Commission, and the Public Company Accounting Oversight Board. In addition, we are also going to cover the factors that will influence the auditor's independence. The auditors of public companies must comply not only with the standards set by the American Institute of Certified Public Accountants, but the auditors of public companies must also comply with the independence requirements set by the Sarbanes-Oxley Act, the Public Company Accounting Oversight Board, and the Security Exchange Commission. The Sarbanes-Oxley Act and the Security Exchange Commission restrict the non-audit services that can be provided to publicly held companies. The Sarbanes-Oxley Act also requires that an audit committee of the publicly held company be responsible for the appointment, compensation, and oversight of the auditor. There are also rules concerning the following issues that an auditor must comply with. These are rules concerning the conflicts arising from employment relationships, rules regarding a partner rotation in a certified public accounting firm, rules related to ownership interests, rules related to shopping for accounting principles by the client, or what we call opinion shopping, as well as rules related to engagement and payment of audit fees by management. So far, we have discussed several of the rules and requirements of the Professional Code of Conduct under the American Institute of Certified Public Accounting Standards. In the next few slides, we are going to continue our discussion, but in terms of the other rules or requirements under the AICPA Code of Conduct. We begin by discussing about the integrity and objectivity rule under the AICPA Code of Conduct. Integrity can be defined as impartiality in performing all services by the auditor, while objectivity is defined as performing services in unbiased manner. Under the integrity and objectivity rule, a member of the AICPA shall maintain his or her objectivity and integrity, and a member shall also be free of conflicts of interest, and as well as a member shall not knowingly misrepresent facts or subordinate his or her judgment to others. The 3-code rule relates to the adherence of the auditor with the requirements of the AICPA technical standards. The AICPA technical standards require a member to follow the general standard rules, be in compliance with the standards rule, and as well as follow the accounting principles rule. The first technical standard under the AICPA Code of Professional Conduct is the General Standards Rule. Under the General Standards Rule, an AICP member shall comply with the standard of professional competence, the standard of due professional care, the standard of planning and supervision, as well as the standard of sufficient relevant data. A member is also expected to comply to any interpretations of the standards by bodies designated by the AICPA Council. So, what is the standard of professional competence? The standard of professional competence requires a member or a member's firm to undertake professional services that a member or a member's firm can complete with professional competence, whether or not that service is an attestation or an audit engagement services. Under the standard of due professional care, a member is expected to exercise due care in the performance of professional services he or she undertakes. The next standard under the general standard rule is the planning and supervision standard. Under the supervision and planning standard, a member must adequately plan and supervise the audit engagement. Followed with this is the standard of sufficient relevant data. Under this standard, the member must obtain sufficient relevant data to afford a reasonable basis for conclusions or recommendations for professional services performed. Moving on to the next technical standard, the compliance standard requires a member who performs auditing, review, compilation, management consulting, or other professional services to comply with the standards rule established by bodies designated by the AICPA Council. The third technical standard under the rules of the Code of Professional Conduct is the accounting principle rule. Under this rule, a member is prohibited from expressing an opinion on the fair presentation of the financial statements if a departure from generally accepted accounting principle is not justifiable and no acceptable support could be provided for the departure from GAAP. In addition, a member is not allowed to make a statement related to the financial statement that she or he is unaware that material modifications to the financial statement must be made in order for the financial statements to be in conformity with generally accepted accounting principle, unless such departure is justifiable and the reason why compliance with GAAP would result in a misleading financial statement, thus a modification to the financial statement is necessary. The other rule of professional conduct is the rule of confidential client information. Under this rule, a member in public practice shall not be permitted to disclose confidential client information without the client's consent. This rule shall not be construed to relieve a member's obligations related to the technical standards, the member's obligation to comply with a validly issued and enforceable subpoena or summons, or to prohibit a member's compliance with laws and regulation. The rule also shall not be construed to prohibit a peer review of a member's professional practice under the AICPA, the State CPA Society, or the Board of Accountancy authorization. And lastly, the rule shall not preclude a member from initiating a complaint with or responding to any inquiry made by the Professional Ethics Division or Trial Board of the Institute, or a duly constituted investigative or disciplinary body of a state CPA society or board of accountancy. Another rule of the professional conduct is the contingent fees rule. In order to maintain objectivity in conducting audits or other attestation services, basing fees on the outcome of engagement is prohibited under the Code of Professional Conduct. Preparing a client's tax return for a contingent fee is also prohibited under this rule. When non-attestation services is provided for a client who is also receiving attestation services, the need for independence and objectivity prevails, and in this case, the auditor is not allowed to provide these services on a contingent fee basis. An exception to the contingent fee rule becomes applicable when the fees are fixed by courts or other public authorities. In tax matters, fees are not regarded as being contingent if the fee is determined based on the results of a judicial proceeding or the finding of a governmental agency. The other rule of professional conduct is the commissions and referral fees rule. Commissions are compensation paid for recommending or referring a third party's product or service to a client. It can also be a recommendation or referral made for a client's product or service to a third party. Restrictions on commissions are similar to the rules on contingent fees. Certified public accountants are prohibited from receiving commissions for a client who is receiving attestation services from the CPA firm. A CPA firm does not violate the AICPA rules of conduct if it sells such things as real estate, securities, and entire firms on a commission basis if the transaction does not involve a client who is receiving attestation services from the same CPA firm. The reason the AICPA prohibits commissions for any attestation service client is the need to ensure that the certified public accountant firm maintains its independence when performing attestation services. Moving on, let us discuss about the advertising and solicitation rule. Solicitation consists of the various means that CPA firms use to engage new clients other than accepting new clients who approach the firm. Advertising is one form of solicitation. The standard of rule prohibits a member in public practice to seek and obtain clients by advertising or solicitation in a manner that is false, misleading, or deceptive. Likewise, solicitation by the use of coercion, overreaching, or harassing conduct is prohibited under the advertising and solicitation rule. Another rule of the Code of Professional Conduct is the form and organization and name rule. Under this rule, practitioners are allowed to organize in the form of a structure such as the proprietorship structure, the general partnership structure, a general corporation, a professional corporation, a limited liability company, or a limited liability partnership, as long as the structure is permitted by state law. A certified public accountant firm may use any name as long as it is not misleading to the public. Non-CPAs are allowed to have ownership interests in a CPA firm as long as a majority of the firm's financial interests and voting rights are owned by CPAs. The Code of Professional Conduct has a specific rule prohibiting acts discreditable to the profession. For guidance as to what constitutes a discreditable act, the AICPA bylaws provide a clearer guideline in comparison to the AICPA code. In addition, the AICPA bylaws state that membership in the AICPA can be terminated without a hearing for judgment or conviction for any of the following crimes: a crime punishable by imprisonment for more than 1 year, the willful failure to file any income tax return that the CPA as an individual taxpayer is required by law to file, the filing of a false or fraudulent income tax return on the CPA's or client's behalf, and lastly, the willful aiding in the preparation and presentation of a false and fraudulent income tax return of a client can lead a member to be terminated under the AICPA. Interpretations of the acts of discreditable rule identify several acts that are considered to be discreditable. For example, it is considered to be a discreditable act when a certified public accountant retains a client's record after a demand is made by a client for the records. In addition, it is also considered to be a discreditable act when a member is found to have violated any federal, state, or local anti-discrimination laws. A member in business is considered to have committed a discreditable act if by the member's negligence others are made, permitted, or directed to make materially false and misleading entries in the financial statements and records of an entity. In addition, the member fails to correct financial statements that are materially false and misleading, or the member signs, permits, or directs another to sign a document containing materially false or misleading information. In here, we have a summary of the rules of professional conduct as I have discussed in the previous slides. You can find Table 4-4 on page 104 of your textbook. In the next slide, we are going to discuss the AICPA, the State Board of Accountancy, and the Public Company Accounting Oversight Board enforcement mechanisms for the professional conduct by certified public accountants. The AICPA Professional Ethics Division is responsible for investigating violations of the Code of Professional Conduct and as well as deciding the disciplinary action of a member. There are two primary levels of disciplinary action. For less serious and probably unintentional violations, the division limits the discipline of a member to a requirement of remedial or corrective action. The second level of disciplinary action for a member is an action before the Joint Trial Board. The board has the authority to suspend or expel members from the AICPA for various violations of professional ethics. The State Board of Accountancy also has rules of conduct that are similar to the AICPA. A significant violation by a certified public accountant of the State Board of Accountancy's Code of Conduct can result in the loss of the CPA certificate and the license to practice. On the other hand, public companies are subject to the Public Company Accounting Oversight Board sanctions. The Public Company Accounting Oversight Board has the authority to investigate and discipline registered public accounting firms and individuals for non-compliance with the Sarbanes-Oxley Act. In addition, when violations are found, the Public Company Accounting Oversight Board can impose appropriate sanctions, including suspension or revocation of the public accounting firm's registration, or the suspension or barring of an individual from associating with a registered public accounting firm, as well as the Public Company Accounting Oversight Board can also impose monetary penalties to a member CPA or a member CPA firm. We have reached the end of the Chapter 4 discussions. Chapter 4 covered the roles of ethics and the ethical responsibilities of certified public accountants. In addition, under Chapter 4, we also covered the oversight, the rules and standards of the AICPA, the Public Company Accounting Oversight Board, and the Security Exchange Commission in relation to the professional activities of certified public accountants. Please complete the required evaluation method for Chapter 4 as it will be part of your final grade. Homework and quiz are to be completed and submitted by the specified due date. Please use Blackboard and Pearson's MyLab, also called My Accounting Lab, to complete your homework and quiz. You have reached the end of the course presentation for Chapter 4. Please access the video for Chapter 5 for the next presentation of the course.